Nadine Blaney from AusBiz here. Our next presenter is Angus Benbow, CEO of Centrepoint Alliance. So I'll tell you a little bit about the company to start. Also, don't forget, if you have questions for Angus, feel free to put them into the Q&A section that's located at the bottom of your screen. Centrepoint Alliance is a leading provider of advice and business services to financial advice firms right around the country. It offers a complete suite of governance, business management, client growth, and advice services that really do enable advisors to spend more time providing advice to their clients. Centrepoint Alliance is proactively leading the evolution of financial advice business models in Australia. It has introduced clear, fee-based pricing that supports the provision of more transparent and better financial advice for Australia and Australians, increasingly through the use of digital and data technology-enabled solutions. So a reminder, please submit your questions via the Q&A panel on your screen, and listen in to Angus Benbow, CEO of Centrepoint Alliance, who joins us now. Angus?
Thank you. Thank you for that. Welcome, Nadine. I'm sharing my screen, so I think hopefully everybody online can see that. So what I thought, I'd just take you through a collection of slides to describe our business, Centrepoint Alliance, to provide a better understanding of what it is that we do, how we're different in the market in terms of versus our peers, and where we see the opportunities playing out for our advisors, but also the growth in Centrepoint Alliance. Obviously, disclaimer that these slides are all taken from either the half-year results pack just recently in terms of the first half of FY21. There is one slide in there from the full year results pack that we released back in August of 2020, so the FY20 year. So if there are any slides of interest, they're all publicly available through the last two results in packs that we sent to the market. So in summary, our business from a gross revenue perspective, which is all of the revenue coming into Centrepoint Alliance for the half year, was 70.6 million, which was a 15% increase on the first half of the prior comparable period for FY20. And that was driven by a really strong increase in the underlying quality of the advice firms that we've been attracting, and also the acquisition of an advice technology company called Inzuma, which I'll talk to later. EBITDA for the first half was 2.1 million, which was a turnaround of 1.8 on the first half of FY20, which put us in a cash position of 14.7 at the 31st of December, which was a 107% increase on the prior period, or comparable period, leading to our ability to distribute a special dividend and a ordinary dividend of 3 cents special, 1 cent, which were all fully franked. This, I guess, financial turnaround, we've got a very simple and clean balance sheet. We have no debt. Obviously a remaining good cash position following the distribution of the dividends, as a result of effectively a significant transformation and turnaround of the core advice business over the last 2-3 years. So what it is that we do, we provide services to financial advisors, be it either licensed advisors or self-licensed advisors or other licensees in the financial advice industry within Australia. We believe that good advice promotes well-being, and whilst the industry has shrunk over the last couple of years with an exodus of advisors, the demand for good financial advice continues to increase, and we are positioned well to take advantage of that demand and it's also positioned well for the structural changes that are playing out in the industry, and I want to take some time to go through that. Probably other headline results there: new business. To Dee's point, we have seen a big increase in our underlying AR fees. There was a 190% increase since the first half of financial year 19. And that's as we transition to people to fee-for-service revenue line without any cross-subsidisation of historical rebates and things like that. Other exciting sort of opportunities are revenue extensions. We purchased the Inzuma advice technology consulting firm at the end of last financial year from Chant West, and that's been a really great acquisition from us, one from a strategic fit, but also from a value and accretion perspective, and that's been fully integrated. And we'll look to continue other revenue extensions like that where we can see opportunities for the business. So as I said before, what it is that we do, we're a national advice and business services firm. Probably in the past, you would have heard about these firms called dealer groups or licensees. We've probably stepped past that, and we would see ourselves as an advice and business service provider. In taking that step, it's also a key focus for us is around what are the scalable services we can provide and what's the scalable platform from which we need to invest so we can get more services at scale to more advisors. I think this chart shows the very significant national presence we have. Combined with the licensed advisors, which sit at about 308, we've got probably 800 plus self-licensed advisors involved in the community, plus a number of wholesale licensees, and I'll talk about that more shortly. So it puts us from a size perspective, just under your AMPs and IFFs of the world in terms of a total community of advisors from which to pass on the benefits of our scale. Drilling down more into the specific market opportunities that we see. There may be many on this call that haven't worked or been exposed to the financial advice industry of late, but obviously it's gone through huge amounts of change over the last few years with the Royal Commission, had gone through significant changes prior to that. And we see that as an opportunity for Centrepoint Alliance. Markets going through disruptive change where there's more requirements for investment in technology and regulation needs. There's more of a demand for services from the underlying financial advice businesses. Means that they're generally looking at partners who are in a strong position, in a market leading position, who've invested in their core services. And we believe at Centrepoint Alliance, we have been quite distinct in terms of we're uniquely placed in making some first mover advantages or steps around the commitment to advisors. But as we look at the market, there are effectively three core segments that we look at, and then a revenue extension. I just want to spend a little bit of time talking about each of those because it probably provides a sense of who and what we do, who we are and what we do. Under the licensee, that's our core business. We have about 308 advisors there at the moment, which you see in the bright blue box down the bottom. And our ambition over the next 2 to 3 years is to grow that out to at least 500 advisors, and that may be organically or inorganically. What it is we do as a licensee for effectively our clients are small to medium-sized advice firms that may have 1 to 10 advisors. They're self-employed, so they're small businesses who may sit in a small regional town or large regional town, or in the city where they're running an independent financial advice firm, or not independent in the technical term from ASIC, but what they would see is that they're not aligned to a vertically integrated organisation, or also they're not salaried where previously they would have sat as a salaried advisor in a bank or aligned organisation. So they see themselves as self-employed business owners, but they don't want to go out and be self-licensed. So they want to use our license, and with that, we provide bundled services. On average at the moment, the blended advice fee for advisors who sit on our license is about $36,000. The good thing about that from a revenue perspective, it's very subscription based. Average tenure of advisors who've been with us for greater than 18 months is sitting at about between 8 and 11 years. So once they come on, very sticky annuity type subscription revenue. As I said, average revenue per advisor from a blended perspective at the moment, about $36,000. We then move across to the next segment, the self-licensed. This is a segment that has got significant attention over the last couple of years. It's a significant market. There's about 5,000 of the 20,000 advisors, so 25% of the market sits in this space across about 2,000 firms. So in this space, what we do is we don't provide a license, obviously, they're self-licensed and self-employed firms, but we provide the benefits of our services at scale for these firms. These firms still require licensee support and governance services, audits for their financial advisors, they need advice technology, etc. Now, if you've got a small financial advice firm with 2 or 3 people in it, their focus is on their clients, not on providing all of the licensee support. So they can come and rent that effectively from us. Again, subscription-based annuity style revenue. And for us, it's not, because we've got a lot of our services, online technology, scalable through technology, intranet sites, etc. It's very scalable revenue for us in that space. Wholesale licensee is the next space that we focus on. So going back on the self-license space, we probably are, us and BT Select or BT Open are the number 1 and 2 providers of services in that space at the moment in the market. So very well positioned, strong and historical presence in the self-license market, which we're looking to take advantage of. In the wholesale licensee space, this is where we provide, again, same scalable services, what we do around governance, licensee support, advice services, but to licensees who want to maintain a license or want to maintain a business focused on a community of advisors, but they want to use the benefits of our scale and services. So effectively at institutional level or wholesale. So we have 2 wholesale contracts in place, both of which have only been put in place over the last 12 or 18 months. And we think this is an opportunity, emerging opportunity for us to leverage our scale. And we'd like to grow that out in the next 2 to 3 years to about 15 wholesale clients. Now, we see that the wholesale licensee opportunity, and I had a slide in the half-year results pack about this, I didn't bring it across to here. There's probably 70 licenses that have got, or they're not probably, there are 70 licenses that have got between 30 and 100 advisors. Now, for those firms, we don't see them having enough scale to invest themselves. They need to outsource to people like us. And the exciting piece of the opportunity then is to say, once you've got that community of advisors, small business owners, perhaps in 2 or 3 years' times, based on delivery of this ambition, you've got effectively 600 firms across 2,000 advisors as a proxy of the scale in the business and of what's possible. If you then think about what are the other revenue extension around business services, technology services that these small business owners require to continue to operate, but also to operate more efficiently and see more clients. And that's where we continually push. And that's things like Inzumo, the advice technology consulting firm, is a natural extension into that space. I did spend a bit of time on that slide just for those people who aren't familiar with our business, to give you a sense of what it is we do and who we do it for and what the market opportunity is. As an example of the industry disruption, this is a slide, I'd like to have you focus on the middle chart. This is for all of licensees in the Australian market who've got greater than 10 advisors. As you can see, the advisor numbers have reduced there, even in the last first half FY20 to first half FY21. Going from 18,800 down to 15,900, so a significant reduction. Yet the number of licenses hasn't changed that dramatically, 269 to 237. So we're not seeing the same level of reduction in licensees as we do in advisors. So this is where we do see, given that cost of regulation are going up, cost of running a license, PI insurance, investment technology are all going up, yet the revenue models of these firms are coming down or being compromised, as well as all cross-subsidisation now is effectively banned. The significant revenue restructuring has taken place for licensees, which will, in combined with significant increase in costs, we will see, I believe, a consolidation and an acceleration of that consolidation over the next 12 to 18 months. And that's where the benefits of scale play through. Centrepoint Alliance is positioned very well to capture this, given the investments that we've made over the last couple of years in our business in transforming it. But as not only have we transformed the financials and the revenue model, we've also focused on investing in our core services. This chart, quite busy. I'll just focus on the left-hand side. In the bar charts, this is independent research from Core Data that they conducted last year in July, or August, July, which talked about what are the top factors that you consider when joining a license. And you can see there that compliance support, then advisor technology and technical services are the top 3 factors that advisors look for when joining a new license. Underneath that, in the round bubbles, I guess, is the internal Centrepoint Alliance advisor satisfaction against these metrics. So 82% of our advisors are satisfied in our compliance support, which is fantastic. 72% in our advisor technology and 87% in technical services. Now that 72%, whilst high, I'd say will be further bolstered with the acquisition of Inzumo that's been fully integrated. So we feel that we are well placed to capture the movement and the disruption that's playing out across the industry. which is also validated by at the financial, not the financials, but the advisor movement flowing through our business. So starting, I guess, in the middle, you can see the top above the bars there, 12-month movement of advisors. The first half of FY20, we had 55 advisors join, 30 of those being a wholesale. Second half of FY20, 24, and the first half of FY21, 27. So that's 27 advisors in the first half of this financial year. As we were coming out of COVID, as the market was quite subdued, 27 new advisors joining the business. Now, we did have some people moving on, but predominantly those are those people who are exiting the industry or ceasing to be an advisor completely as an AR. So we did expect that to play through. What we were very pleased about was that we still maintain that growth in terms of new advisors joining the license, because the exits in terms of are those people who are effectively retiring or choosing not to participate anymore are in line with the industry. But what we've seen is obviously growth that's above industry. And that's why when the underlying results, I think we've grown our market share by a few percentage points, I think 5 or 6 percentage points from an underlying perspective. Again, a highlight is the improving of advisor quality, where the people who are departing, again, exiting due to retirement or ceasing being AR, it's 173,000. Those who are joining are sort of 370, circa 370,000. So double sort of the amount of revenue in terms of quality. And that's what's driven that top line gross revenue increase of 15%. So wrapping up pretty quickly now is the advice technology. We have made significant investments around technology partnerships, the acquisition of Inzumo over the last 3 years, have recently, or not recently, but over the last 2 years, formed a very good partnership with IntelliFlow, which is a leading advisor of device technology solutions in the UK market, which is about to enter the Australian market. They've been working with Inzumo and us. We've got a lot of partnerships with other third-party providers, which are integrated into our advice technology through third-party advice, open architecture applications. And we also have made an investment over the last 2 or 3 years in our own data and Centrepoint AI platform from a deep data analytics perspective to provide those services to our advisors. Just in summary of the transformation over the last 2-3 years, you can see there sort of the turnaround that we've experienced from a gross revenue perspective, up from 60.2 to 70.6. Our expenses, despite running a transformation through the business, we didn't take on new costs. In fact, we reduced our costs substantially year on year through that period, with a reduction of FTE from 109 to sort of 90. But at the same time, having more people supporting our frontline advisors. And that's led to a very healthy cash position in terms of growing that cash position over the last couple of years, leading to a very simple and clean balance sheet, despite the level of transformation disruption across the industry. So we're really pleased with those results that are flowing through. It's a testament to our advisors for their support, where we've effectively increased their fees, so you see there, by double in many instances. So we've had a 100% increase in our underlying AR revenue since the first half of the financial year 2019, which has transitioned to the business to that reoccurring fee for service. So very good subscription annuity type revenue, which our advisors have signed up to. Clear focus for the second half of this year remains on capitalising on our strong position to grow organically and inorganically, both in the licensed and self-licensed market, continue to take advantage of the scale advantage through advisor technology investments and extensions, and leverage what has been a strong share price appreciation since results last year through the second half of last calendar year, and balance sheet flexibility to pursue consolidation opportunities for the business. So I'll round up there and open to any questions.
Angus, thank you for that. I think you can hear me now. We've got a few questions that have come in. I will get to them now. We've got a question saying licensee revenue per year is 36,000. So what is the average revenue per year for self-licensed clients and wholesale clients?
Yep. So the for self-licensed clients, interestingly, for those people who, what we're seeing, we're transitioning our self-licensed advisors to a fee-for-service model at the moment, which is in, I think, the first chart. So some of that historically had been rebate. On average, we're probably seeing people come across at $10,000 or $12,000 for the self-license, but for new self-licensed advisors joining, that could be in the order of 20,000. So it does change depending on whether they're new to the business. They generally take up more services versus those that have been with us for a long period of time. Given that they haven't been being charged directly for those, given it was subsidised, generally it's to a lower price point initially. Then we look to move that up.
Okay, another question as well, and I think this speaks to some of the disruption and the changes that are going on in the industry right now. Just saying, with the number of advisors falling, does that limit your growth aspirations in the next 2 to 3 years? Where do you see the number of advisors in the market stabilizing at from the current 15,000?
In terms of where we're at the moment, I think people are sort of seeing the number. I think we're at about 20,000 overall, including self-licensed, that, you know, will stabilize between, I guess, 15 and, I guess, 17,000 thereabouts. The exam, in terms of for the FCA exam, needs to be completed by the end of this calendar year. So we will see a few more advisors transition out over the course of the next 9 months, which will come down to that number, and we can rebuild. We don't see that as an impediment to growth, given the structural changes and challenges that the industry is facing. So there are 200, I think it was said, you know, there was 260 licenses that have got greater than 10 advisors. And we're of the very firm belief that scale will win, and you need probably 300 to 400 advisors to truly operate as a scale player as a licensee going forward. So I think there are going to be a lot of consolidation opportunities playing out in the market, given that to run a license takes a certain amount of fixed costs, and that fixed cost really comes in at a couple of hundred advisors. So unless you're operating with scale, you will either have to merge with others or partner, or outsource some of your services to other scale providers such as us. And that's where we're sort of playing both sides by offering wholesale services where we can be an outsourced provider to small licensees, or pursue things from an inorganic perspective as well.
Okay. Do you see any further merger or acquisition type transactions on the horizon?
We do. So, you know, we believe that over the next 12 or 18 months, there will be significant action or activity across the market. We're seeing that at the moment. And it just comes to that basic macro dynamics of where the market is at. Costs have been increasing, revenue models are under threat, and advisors are expecting more from their licensees in the services that are provided. And as I've said a number of times, that those services need to be invested in, and that's where you need a scale provider such as Centrepoint Alliance.
Your plans for capital management between reinvestment for growth versus paying out dividends, what are those?
Look, we remain flexible, and I think in the chart there that we're looking at the moment, it's around balance sheet flexibility, that where we see opportunities for growth, as we did with the Inzumo acquisition, we will pounce on that and quickly. And there was a very accretive acquisition that we've integrated, and it's been a success. But where we don't see opportunities right at that time, we'll distribute a dividend, as we did at the first half. So it really is, we do maintain that balance sheet flexibility. We've also had good share price appreciation over the last 6 to 9 months as well, which gives us further flexibility as well. And, you know, in this market, we also see that the opportunity to raise money to pursue growth initiatives is we're not held back from as well. So that's why we talk about flexibility. I guess it's not one or the other. We're looking at a range of capital management initiatives to drive the growth in the business. Okay,
so where is the biggest challenge then, Angus, as you go further into 2021?
I think that the biggest challenge is one, pursuing the growth of advisors. You know, I think it's well documented around some of the failures of licensees in the market. So in partnering with new firms, be it acquisitions or organically growing, it's attracting the right quality advisors that don't create too much risk in your business. But if you are looking to acquire or merge with another business, it's making sure that we're partnering with the right organisation that doesn't bring historical risk to the table, or expecting a price that maybe was relevant or was in the market 5 years ago. There has definitely been a recalibration of what businesses are worth. We are reasonably prudent in the way that we go about our acquisitions and the way we look at things. So it's just making sure that we're attracting the right opportunities at the right price.
And there's no thought right now that Centrepoint Alliance could be the subject of some sort of takeover or
not necessarily. We're open to all conversations. So look, we do see that the industry needs to move to consolidation, and if something's on the horizon that's going to enhance our shareholder value, then we will definitely be a part of all conversations to leverage the scale and the investment that we've made in the business, but to also leverage that for our shareholders.
Angus, we've come to the end of the questions that have come in. Angus Benbow, Centrepoint Alliance CEO, thank you so much for your presentation today. I'm sure you'll make yourself available as need be for any questions that will come in after the fact.
Absolutely. Thank you very much.
Thank you.
Thank you for the opportunity. Bye-bye.